Can you guys see everything okay? And you can see me and hear me? It's only a couple, so really let's make this fairly interactive, because if I'm talking about something that none of you care about, let's move on. But basically I'm just going to talk about the entity type today when you're starting a business, and the tax basics surrounding that entity, and some accounting basics too. So there's my picture. First we'll talk about the choice of entity. There are 4 basic types of entities. Within these entities and other special situations there are different types of entities, but these are the 4 basics. So sole proprietorship, partnership, S corporation, and C corporation. Do any of you have entities yet?
Yes.
What is yours?
Sole proprietorship.
Perfect. That's a pretty easy one. Anybody else?
Yeah, LLC.
Cool.
LLC.
Okay. Yeah, and an LLC can tax file as any of these too. So for LLC, for state purposes, could really be any of those. Some basic tax ramifications of each, and we're just going to talk federal. States can be so specific. So depending on your state, obviously we're all in Washington, we don't have income tax, so we'll just kind of talk about tax of each 4 of those, and then some basic accounting and what's required when you have each of these entities, and then questions, but please ask throughout, because that makes it better and makes me less nervous. So if we just talk a little bit about the choice of entity, just those 4, some things to consider would be who will own the entity. So if it's just you, if it's a group of people, and the relationship that you guys will own that, if that's more than one person. So maybe it's a husband and wife, that could still be considered one. But also the different types of entities. If you have like a partnership, for example, the equity setup can be pretty loosey-goosey. So one person can contribute money, one can contribute work, and that works pretty well. In an SCorp, it's a little more rigid. In a corporation, it's a little, or CCorp, it's a little more rigid. So depending on who's going to own and work, or own or work, or however that's going to work, it might depend on the entity you pick. And then 3 of those 4 types of tax return, or types of entities listed, have their own tax return, which we'll talk about, but they are separate entities that will file a tax return that may be reported on a personal return, or it may be a separate reporting and that entity pays tax, so we'll talk through that. And then, like I mentioned a little bit earlier, the states do allow you to file as an LLC for protection purposes, but you can still be a sole proprietor, partnership, SCorp, and be an LLC. And then it is just usually a good idea to file an LLC so that you do have that layer of protection. And then also want to consider how you want to get paid as the owner. So like a sole proprietorship doesn't take wages, you just take money, and that's how you get your payback. Where in SCorp you would set up a payroll, even if you're the only employee and the only owner, you still have to do payroll inside of an SCorp. So just considering how you want to get paid might help you choose your entity. In any of those 4 entity types, you can have payroll. In a partnership and a sole proprietorship, the owner would not get paid wages, but if you have a team, you would still have payroll for that team. And that's an added expense and added taxes, so just something to consider. Like if you aren't going to have payroll aside from you, maybe sole proprietorship makes sense initially because you don't have to do payroll in that case. But in any of those cases, you could set up employee benefits, retirement plans, and in a sole proprietorship, even if you don't have payroll or wages to pay anyone else, you can still have those plans for you. Kind of mentioned this earlier, everything has a cost. So if you do have payroll, whether you're preparing it or you're paying someone to prepare it for you, that's an added expense. The payroll taxes for your employees is an added expense, but just the different types of entities you set up will have different reporting requirements as well. So for example, a separate tax return, you might have to pay someone to prepare that. For sole proprietorship, it's on your personal return. You're already preparing a return, so it's not a separate one. So just some things to consider when you're starting out, how much money you're going to make, what level does it make sense to pay someone to do some of that work for you. And then it's always a good idea to look at your goals. So if you have goals to set up an entity in 5 years, make it awesome and sell it, there's better exit strategies depending on which entity you pick. Or maybe your goal is to just not make money for the first couple years and then get some deals and make a lot of money later. So maybe you start as a smaller sole proprietorship and then work your way into something, transfer into maybe an SCorp later. Just depends on all these factors obviously, but understanding your goals helps to set the stage for what entity type you want to be. And then at what point do you expect to cash flow or have income? A sole proprietorship is a great place to start, but then when you start making tons of money, you're getting self-employment tax on all of it. So in an SCorp, you could maybe structure that so that you take some as wages and some as distributions, and so you're not paying 100% of the income at self-employment tax rates, which you are in a sole proprietorship. So just things to consider: at what point are you going to start making money? Maybe you start as a sole proprietor, 5 years down the road you go to an SCorp when you already have payroll and you already have all these things, and you want to start saving some money on the self-employment part, which we'll talk about later too. And then maybe you talk to your banker and you're like, what kind of entity would get a loan best? You know, maybe if I'm a sole prop, will you give me a loan, or do I have to do that personally? Can I guarantee that personally? Or maybe you know, they'd rather give money to a business. So it depends on those relationships too. And then what's your personal situation? So 3 of the entity types: sole proprietorship, SCorp, and partnership, all that income flows to your personal returns. So you know, if you are trying to buy a house or something, maybe having a fatty loss on your sole proprietorship tax return would not look great if you want to buy a house in 1 or 2 years. So maybe having a C corporation so that you have a nice financial separate personal situation, and this corporation is separate from you. Those are kind of the weeds, of course, but just making sure you look at your personal situation to pick one might make sense. And maybe if you have partners or people doing it with you, their personal situations as well, so you guys all get the best situation. Does anyone have questions on the big picture considerations? Yeah.
So on the sole proprietorship, there's no tax benefits to take a payroll or not, because you're just collecting the income. Is that what you said?
So for a sole proprietorship, it's just filed on your personal tax return, and there is no, you can't take wages from it. You can't set up a payroll to take wages. So whatever the business earns, say it earns $50,000, that just is directly on your tax return, but it's treated like wages. So you have to pay Social Security and Medicare on that. You do get a deduction for the part that your employer, you know, would have paid, because if you have a W-2, they pay half and you pay half. So you do get a deduction for that on your personal return. But yes, everything that the income that the company makes, doesn't matter if you actually take money out or not. You still have to pay tax on that and self-employment tax.
So can I ask another question? So is there a kind of a guideline for moving from like a sole to SCorp as far as income? You said there could be some tax benefits. Is there some type of, you know, hey, when you hit X, this might be a good time?
It kind of depends, because the SCorps are a more complex beast. So you do have to consider, let's say if you make $100,000 in your Schedule C, and we'll just say that with the 15% self-employment tax-ish, and maybe another, trying to keep it easy, 15% we'll say for tax rate. So you have 30% tax you're paying on the whole thing. And that's on your whole 100,000. Let's say you could move it to an SCorp, and you could take 50,000 as wages and 50,000 as distributions. So you're still going to pay tax essentially on $100,000, but 50,000 of it's going to be taxed at that 15% employment rate and the tax rate. The other 15% you just pay income tax on, so it's at 15%. So also, that being said though, you're paying half as much self-employment tax, but whatever that difference is, let's just say it's $7,500 of savings. I don't know, I'm not just pulling numbers out here, but the cost of a SCorp tax return could be $3,000, $4,000 or something, you know, I don't know. And then maybe the cost of having someone do payroll, because you're as an owner taking $50,000 in wages. So even if you have no employees, you still have to prepare your 941s, your states. Well, state you're probably exempt, but all of those tax returns, maybe that's another $2,500. And so maybe you're right up there where you would have been anyway. So that's kind of the gauge that I would use, is like at what point, you know, are your tax savings enough to cover your extra cost of having any? Plus, you definitely have to keep it separate. We're in a Schedule C sole proprietor, you can be a little loose on the guidelines there. So you have a separate maybe accounting system, maybe what is that, and all those costs that make an SCorp more expensive to consider. But also, if you're going to have payroll anyway, you're going to have people working for you, it's an easier jump because you're already paying that payroll piece, so that you don't have to consider a person to be paid to do your payroll for you. So I don't know. That's kind of what I would go through.
Thank you.
Yeah. Any others before we?
Yeah, who would we go to? So 2-3 years down the road, things are getting really complex, things are happening and moving quickly, to be advised on which route we'd like to go moving forward, who would we talk to?
You could call any CPA firm in town, really.
CPA,
Yeah.
okay.
Yeah. I mean, basically, an attorney would write up if you were going to switch your entity type totally and needed new articles of incorporation or something
Okay.
from your sole proprietor to be registered with the state and
Sure.
all of that, or even just have articles to follow.
Okay.
But a CPA would be able to walk through kind of that discussion we had about what point makes sense to change and.
Right.
And if SCorp makes the most sense, and making sure you file timely because you have certain timelines from the previous year to go to an SCorp you can't just pick the day your return is due to do that. Usually you got to have some advance. So doing the planning, for sure, any CPA could do that.
Okay. Great. Thank you.
Am I not loud enough? You keep missing with if you can hear me. Well, you can hear me, but. Okay, so I'll just go through, sorry, any more? You guys are gonna get my whole presentation out of me before we get done here. So I'll just go through quickly a sole proprietorship, kind of the basics, which I sort of did touch on, but the business is you. You can just have your account, your everything. You don't have to do anything separate. You can just keep your receipts, give your CPA a box, or whatever you wanna do. Doesn't file a separate tax return. So there is a schedule on the 1040. It's called the Schedule C, and I think I have a screenshot in here later in the tax section, but that's where all that information goes, and it's pretty basic. You could do it through TurboTax with limited additional expense. Like I mentioned, you can be an LLC for state purposes, and the owner does not get paid wages. So really, if you have your bank accounts one big mushy, and you just keep your receipts, when you have income, you just keep it. You don't have to do anything special with it to be considered income. It's just at the end of the day, with the total money you received minus the total expenses you have, that's what you pay tax on. So it doesn't matter what you put in your own bank account or move around or not. That kind of is what it is, and that's what you pay tax on. And as we discussed earlier, all of it is taxed at self-employment rates. So that 15.3% Social Security, Medicare, times 2, basically your half and the employer's half, because you are the employee and the employer. That's up to the Social Security wage base, which I think is $129,000 now. So if you do get above $129,000, 6.2% on either side goes away. And let's say you're starting small and you have a business, or you work for a business, so you have a W-2, you make $100,000 in that company, you only have $29,000 in your Schedule C before you're above that limit. So they do count together. So that could be nice if you're starting out small here. You don't have to consider the whole wage base. If you were an SCorp and you had another business that had W-2, you'd still have to withhold from the W-2 in your SCorp above that limit. You might get some back on your personal tax return, but the employer portion is still going to be paid. They don't have the same limit in that regard on your personal return. So there are reasons too, if you have a separate employee related business, that you might consider staying a sole prop a little longer if you're up in those ranges. As I mentioned too, you can do payroll for your team. You just have to get a federal ID number. So you could even start your sole proprietorship with just your Social Security number and just file. So I make cards sometimes and I sell them for $5 and have a little Schedule C, and it's just me and I have nothing else, and I make like $10 a year. But if I wanted to pay someone, I would just have to get a federal ID number in order to do that, to pay them. Pretty easy, but then you have all the payroll reporting issues. But it is a great way to start out, especially if you don't know how it's going to go or how big you're going to get. It's a great way to start out and just know your options for converting later. I typed in sole prop stats, and this I thought was interesting. In 1990, under 15 million sole proprietors filed a tax return. By 2008, it's 22.5 million, which seems like a big increase. And then there's really only 5.8 million corporations and 3 million partnerships that file. So I just thought that was kind of interesting, those numbers. There's a ton of small businesses in this country. Talk a little bit about partnerships. So basically you have to have partners. I can't be one person and start a partnership, which seems obvious, but sometimes you just think of them all. You can be one person and do the other three, but this is the one you can't. So basically if you are only one person, you would probably default to a sole proprietorship in this case. When you don't pick an entity, kind of, it's like you can't be two people, but the other entities require you to file something. So file to be an SCorp, file to be a CCorp. Anyways, so you have to file to be a partnership too, essentially, but the entity structure is a lot less strict than an S or a C corporation. So like if you have a real estate situation and someone puts in land and someone puts in sweat equity, that's cool because you don't have to be the same and you can kind of value it how you want, and you can still be 50-50 owners and take 50-50 in distributions, even though one put in a $40,000 piece of land and one just worked for 40,000 or whatever that number is. They don't even have to be the same, but which is kind of neat about partnerships. There are some other things within the tax structure and entity. So if you do want to be a partnership, I would advise you talking to a CPA, especially when you're getting in and out, and if you plan adding partners later. But also mentioned kind of below, you can have limited partners. So if this is an entity too that you want investors on, you could be like, give me 10,000, you're a 5% owner. That's pretty easy to do those types of things in a partnership. And you have other owners that are working partners, and then there's limited partners, and you can almost treat them like they're, maybe these working partners get distributions first and the equity partners get distributions later. That's pretty easy in a partnership. That's not easy in an SCorp. You pretty much have to, it's very strict in an SCorp. So if you want to do loosey-goosey stuff, partnership would be a good way to go. You can still do payroll and benefits, but partners don't take payroll in a partnership. Partners get distributions. So in kind of the story in all the entities, you pay tax on what's earned, not on the distributions. So the partnership earns $100,000 and you each get $33,000. That doesn't add up. 100,000, yeah, close enough. 33. You would pay tax on 100,000, which would be your percentage each. But if the partnership had 100,000 and you each got 10,000, you would still pay tax at 100,000. Does that make sense? I'm sorry. I feel like I confused everyone there because I confused myself a smidge with the math complications in my brain. So it files a separate tax return, and everyone would get a form that shows what they should report on their personal tax return. So it does flow through into your personal tax return, but it also has its own separate return, and it can be an LLC for state purposes. Also, I mentioned the limited partners is an option, and it is really used, I always see this one used for real estate, rarely see it used for an operating entity. And it's easier to get real estate in and out of a partnership than in any of the others. But so I guess this is usually, I'll see a partnership owns this building and the operating entity is a separate entity that works out of this building. That's just normally the way we see partnerships. But if you like the equity deal, or there's some other reason you would be a partnership, it is a great option. So don't count it out, but it is a little more difficult to manage with some of the specifics to a partnership. And all of this tax generally is subject to self-employment as well, because you're not taking wages. So any income that comes out if you're an active partner is subject to the self-employment tax, which you'll pay on your personal return. Does anyone have questions on a partnership? They're my least favorite entity, but that's just because they're complex, especially in the equities. When we start doing weird things with percentages, it's harder for us as CPAs to, I don't know, keep track of, maintain. But they're great when they work and when people use them correctly. Just a smidge on S-corps here. So an S-corporation is a separate entity, but it can be owned by one person, two people, up to 100 people essentially is kind of the rule on an S-corp. So there's also very specific people can be S-corp owners. It's individuals, certain types of trusts, so not every trust, estates, and certain nonprofits. Like I said, you can only have 100 shareholders, and it's one class of stock. So that's kind of where the S-corp gets a little trickier in equity. I can't pay, if everyone's a 10% owner, everyone has to get the same distributions and the same benefits. I can't, like in that partnership situation where I paid this guy in land, or I didn't pay this guy but I paid this guy. I have to do everyone equal in the S-corp, or it could be considered not treating it like an S-corp, and they could pull your S-corp basically, and you would just become a corp, or maybe a partnership if that's the way you're secondarily structured. So it can be troublesome if you don't follow the rules of the S-corp, and that gets tricky too sometimes when you have more owners and they're trying to do different things. Someone wants more money. You do pay wages in an S-corp, so usually the answer is someone gets a bonus that's waged. or is treated as a wage, which also has self-employment taxes. So it's a little stickier in those areas, but SCorp is my favorite entity type, just because it is flexible and great for most situations. Not that you guys care about my opinions, but anyways, you do have to do payroll because the owner has to take payroll. That's the way the owner gets wages. The IRS also pays a lot of attention to an S corporation with no wages, because you're totally getting out of the self-employment tax on whatever you've earned. So maybe you go from a sole proprietorship to an S corp, and then you pay yourself no wages, and you were taking $100,000 in wages last year. The IRS sees through that and says, hey, you obviously worked in the business still. Some of this that you took as distributions, if you have $100,000 in distributions, 0 in wages is wages, and they'll call you on it and they'll tax those as wages. So you can't just say, oh, I'm a sole proprietor, I'm going to go to S corp and I'm only going to do distributions. The IRS has caught on to that. But like I said, with the sole proprietorship, if you're already paying your people, it's an easier switch to the S corp, because you're going to do wages anyway, so doing wages to yourself isn't that much different. And like I was kind of saying too, with the wages to the owner, basically the reasonableness test that I mentioned here, so you just have to pay yourself what you would pay someone else to do your work. So if your business is, I don't know, building some computer program or something, whatever you would pay someone to do what you do is pretty much what you should pay yourself. So maybe that's $40,000 a year to write a program. You would pay someone that much as your employee. You just have to pay yourself at least that much. That's usually the best leg you can stand on. The other thing that we'll say is if you're up to the Social Security wage base limit, IRS leaves you alone a little bit more because you're already doing all that tax, and so going much beyond that, the difference is like 2.3%. Shoot, what is that number? 1.45 times 2, 2.9%. It's not as much as getting to the Social Security wage base, which is that 6.2 times 2, so 12.4. Anyways, different tests you can pay attention to when you're an S corp, but you have to pay yourself something. And because you're paying yourself something too, you kind of open up yourself to all employee benefits that exist. You can generally get those in partnership and in a sole proprietorship too, but it's just easier when everyone has health insurance and everyone has the retirement plan and it's all on your W-2s. It's pretty easy. There are some quirks with the owners specifically, but if you're 1 or 2 owners, it's pretty easy to navigate through that. Files a separate tax return, but all the income flows to you personally. So similar to the partnership, it does have a return, but it goes to you for taxes. It may be an LLC for tax purposes or for state tax purposes, and it's not really great for real estate. It's hard to get appreciated property out of a C or S corporation without kind of exposing yourself to basis and other issues. Plus, let's say you have a piece of property you're trying to distribute to 2 owners, like it just gets got to be proportional, and if one gets a apartment building and one gets a cash, and it's just hard to keep those same and keep it in the rules of the S corporation. Also, I just found this little statistic here: 4.6 million S corporation owners were in the United States in 2014, and that's twice as many as corporations. So I just think C corporations, just think that's interesting how many more S corps there are than C corps. Back like in the 80s, before the S corps were around, and me too, but there were only C corps, but some of those I guess maybe have changed, or most of the new corporations become S corps. Any questions on this so far? This is so fun.
I have one question.
Yeah, ask away.
I'm a lot older than you guys, so my questions may not apply to you guys. But so as I get closer to like being able to draw Social Security, and let's say my business, I transitioned into an S corp, and I have to take payroll. I know on Social Security you can only work X number of hours, or it reduces your Social Security. Does that come into play with your own business? Is it based on hours, or is it based on?
I think it's based on wage.
It's based on.
I think it is based on wage, and I think it's a pretty low number before those benefits become percentage reduced.
Percentage reduced.
Yeah.
Okay.
Yeah.
Good.
I don't know what those exactly are, but I would just weigh like.
Yeah.
I mean, even if you had a sole
curious.
proprietorship, I think that's considered the wage that they would use to calculate that anyway. So, so a corporation, which has its own deal, which you'd still take some sort of wage probably from, but that that wouldn't flow to your personal return. I don't know, but yeah, that is a tough place when you
Yeah, that is.
want to take
It is.
benefits.
Yeah.
Yeah. Anything else? Okay, we'll talk real quick about CCorps. Those, basically anyone can own a CCorp, so there's less limitations on the owner types compared to SCorps, where it was very strict. But in the C corporation, the entity itself pays tax. It is its own separate entity. And then if I give dividends out as distributions, those are taxed to the owners. There are, qualified dividend rates that are a little bit more preferential, but it's still basically 2 levels of tax in a C corporation and then the distribution to owners. Payroll is generally required as well because the owners have to take wages usually. It depends, I guess, on how that's structured and everything, but there's usually wages that come out. And then there are reasonableness tests for the owner contribution, but it's on the total end of the spectrum on the other side. So C corporations get in trouble when you pay your owners millions and millions of dollars, where S corporations get in trouble when they pay their owners $2,000. So it's kind of interesting on the opposite spectrums there, but they want to make sure that basically you're not paying your people too much when there should be other ways that they're getting money. I guess because you're over the Social Security wage-based limit and you're not paying as much tax in other ways, and maybe dividends would be the way they should be getting paid. Or, there's so many reasons why, but there's the reasonable tester on the other end. And then there's some more flexibility in the employee benefits and owner benefits, which is when S Corps first came out, C Corps had better benefit situations, so you can pay like the entire employer. No, you pay the entire owner portion in their W-2 for most benefits, where in an S corporation you have to do this fancy calculation to actually make the owner pull it through their return. So totally getting into the weeds there, but there are just some things to consider with regard to employee benefits and owner benefits on a C Corp. And sometimes, like in big doctors' practices, that makes sense, and they are C Corps just based on some of the employee benefit situations. Or they were C Corps 100 years ago and never changed to anything else because of their employee benefit situations. Like I said, it files its own tax return, it pays at the corporate level, and any distributions are taxed. And it's not great for real estate either. It's hard to get a piece of property out because you have to distribute it, which would become taxable twice. Any questions on C Corps? It's hard to look over here. I'm sorry, it's very bright in this direction. Okay, so we'll just talk quickly about the tax, and I kind of did a bit, but I want to talk specifically just about a flow-through entity because this is the most confusing and most common conversation that I have with people. But basically a flow-through entity is an entity that doesn't pay its own tax. So that would be the S Corp, the partnership, and even really the sole proprietorship, because you're going to pay tax. It's wrapped into your tax return. But these are separate entities, S Corp and partnership, that don't actually pay their own tax. And this is at a federal level, so there may be states that don't honor the S Corp, and you would have to pay tax to that state as well as the federal. Well, you wouldn't pay, you'd pay tax, the corporation would pay tax to that state, but you wouldn't federally, and then you'd have to pay personally too. Distributions are not usually taxed in a flow-through entity, but the earned income is. And that can be really confusing. I kind of touched on it earlier, but when you take home $20,000 because that was your distribution, but the company made $100,000 and you're taxed on $100,000, and every dollar you took home has to pay your taxes essentially, because maybe let's say you're at a 20% bracket. That can get really confusing, especially if you have like more than one owner. It seems like those conversations are so difficult, but it depends on your goal and just being upfront with everyone, like, hey, we're putting money back into the business. So when we made $100,000, we're only paying out 20. Deal with it. I don't know. Just depends on. But I do like to see that people, if they make money, they at least pay the owners enough to pay the taxes, because obviously the entity doesn't pay taxes. So making sure that the owners have enough to cover what they're due. So maybe on $100,000, that's 20%, so that's $20,000 that gets paid out. That doesn't always happen, but it makes things a lot smoother for the owners to not have to come up with money to pay the tax on the entity level. Also, the K1 is the form that goes out to people. That's my next slide, so I'll talk about that more there, but it just shows you what income you have to report onto your personal return. And income and deductions flow directly from this entity, so there are some limitations that happen at the business level. and then those flow through to the personal level, and they may be treated differently in your personal return. So maybe there's $100,000 in income, but some of it is dividends, some of it's interest or gains, and those are taxed at different rates, even for different people. So if you have 5 owners and some of them, one person has a different, way wacky different situation than someone else, or even one has 19 kids and so they're in this different bracket and they have different credits than maybe someone that's more near retirement, those 2 owners might still get $100,000 income each, but this one will owe way less than this one. So just trying to be aware and plan as a group is always important. Also, deductions flow through sometimes in ways that could be limited personally, so it is a good idea to tax plan as a group and figure out what makes sense. But in an SCorp, everything will pass through at the percentage, so you can't really pick and choose who gets what deduction based on their return, but you can, maybe with charitable donations, you group those donations because the standard deduction is so high. Maybe you just decide you do all your deductions in January and in December, so in the year of 2020 you have $40,000 so that everyone gets above that limit, versus doing $20,000 in a year where maybe people wouldn't get that deduction. Again, that's getting into the weeds, but those are some things to be aware of. Do you guys have questions on the basics of a flow through? They're super confusing, but can be useful. So kind of hard to see, but this is the draft of the 2019 K1, and over here you can just kind of see ordinary income, rental income, and then if you go down a little bit, there's interest, dividends. That just lays it all out so you can see it's going to flow to each person and how it was earned. So you don't just get like, here's $100,000, pick a box to put it in on your return. They all go into the tax calculation differently. It will also show you down here how much is self-employment income. So that's that amount that will be taxed at the 15.3% essentially. And then the other deductions and some deductions down there towards the bottom, right above the self-employment, those have codes on them that will tell you how they go into your return. And some of those codes aren't really going to even be deductible to you personally, but they flow through to you. So it looks like you have less income, but some of those items become non-deductible depending on your situation. So that can be a difficult conversation to have with partners and owners. It shows kind of your basis or your capital, and then contributions and distributions. And all those things come into play when maybe when we're taking large distributions or we're closing things down, depending on our basis and our capital, or however those equity balances work, there could be tax due on that later as well. So at least this keeps some running totals for you, but that'll all flow through to a personal return. So that was kind of just what a flow through is. So the other option would be a sole proprietorship, aside from the CCorp, obviously, but it has a Schedule C. This is what the 2019 draft looks like. So at the top here, it's got who you are and your business and all of those things, and then it goes down into the gross receipts and cost of goods sold, and then it will go into all your expenses. And that's just exactly, so if you just count up your receipts and here's my income, and count up your receipts and here's my advertising, that's all that you really need to do to do a Schedule C. But like we said too, there's no separate tax return. It's easy for tax and accounting purposes. It's all tax self-employment, which is all things we've already talked about. The bummer with these are you can have a loss of $50,000 in 1 year, and that in the current year will offset your self-employment tax as a loss. But say next year you have a $50,000 gain, you don't get to use that for self-employment offset. It just becomes a net operating loss into the next year. So that's kind of a bummer on that front, but you could definitely do planning to figure out what you do or don't buy to take yourself into a certain loss, or what deductions you do or don't take to get you in and out of certain losses. Again, no payroll is required. Health insurance and retirement plan options are available. Not reported on this schedule, but they're reported generally on just your main return. And you still get, those will offset your self-employment tax, even though they don't go on this specific return, or this specific form of your return, usually depending on the plan, I guess I should say. And as we talked about earlier, you want to weigh the cost of adding the payroll and paying someone to maybe do your payroll, adding the separate entity piece, and how much more that would cost you to keep all that separate before you jump to a SCorp, which was the conversation we had kind of earlier. Any questions on a Schedule C, tax-wise? So if you look on here, I'll just say too, like there's no charitable donations. So if we go to the C, Or there's no, I don't know, I can't think of another good example, but that's the main one where, you know, if you want to be this super charitable person and you want to give a bunch of money, and maybe a bunch is not more than your standard deduction amount, you just basically don't get that deduction. It also doesn't offset self-employment income because it's not an option on this business form. It just flows directly to your personal charitable donation section. And that's the same with a partnership and an SCorp. It'll flow right directly to your Schedule A, which is where those deductions are. And if you don't get above the standard deduction, you basically lose those, and you're paying self-employment tax on them. So just some considerations when it is a flow-through entity or on your personal return to consider what kind of entity. Maybe if your whole plan is to give 10% to charity, maybe you don't do a flow-through entity, maybe you do a C corporation because they don't have the same limits on charitable donations as your personal return does. That's the biggest and best example I can think of, but that's just something to consider. Tax rate comparison. So back in 2018, there was the Tax Cuts and Jobs Act, PG, whatever that was. It was the big deal that changed in taxes. And so basically this is just a chart that showed the differences in what kind of entity you had and what kind of taxes you would pay. So because of C corporation, the highest tax rate was I think 36%. It touched 36 and went back to 35. But it was graduated, so the first 50,000 was at 15%. Then the next 50 was at, or next 25,000 was at a higher percent, and it would go up and up. So assuming you had above all of those limits and you did everything as distributions, so dividends in your C corporation, you would be paying about 50% tax on the income earned in a C corp. They changed the rules to in 2018, so 21% is the flat rate on a C corp now, and so you could get down to 38%. So you could just look at tax rates as an idea of what entity you want to pick, and that ACT column is what's current. This 20% pass-through, so as you can see, the active flow-through owners at 20% pass-through, that 29.6 is the best answer, assuming you hit all of the appropriate boxes to get to that number. But an active flow-through owner with 20% pass-through deduction, that 20% pass-through was the new qualified business income deduction, which was the IRS's way to kind of bring, because of the 21% tax rate for corporations, they wanted to kind of give the flow-throughs an opportunity to take advantage of some tax cuts as well. So basically, in order to qualify for that, you can't be accounting, lawyer, like no professional services qualify. Doctors, all of those professional services are not qualifiable, do not qualify for the 20%. So if you were an active owner, you would be at 37% on the minimum, which is still better than what it used to be, or even what a corporation would be at 39.8. But I guess I just wanted to illustrate for you basically what that would look like. The the passive flow-through is a tiny bit higher because there's the 3.8 net investment income tax that hits at the end of the tax return, and it's 3.8% on basically investment income, which would be if you were a passive partner in a tax return, or a passive partner in a partnership or something, you were one of those investor partners, you'd be subject to that 3.8%. So that's what that's distinguishing there. You guys have any questions on this really confusing tax rate schedule? So if you can do it, a pass-through at the 29% would be the best, but you know, definitely there's way more things to consider besides just the tax rate you're paying. I just did a little kind of side-by-side of a C corporation versus those pass-through entities, and I tried to kind of line them up, but of course when things are longer and shorter, that takes up more or less room. But the C corporation is subject to 2 levels of tax. The partnership and SCorp only subject to 1. Everything flows through to the personal, and they pay tax on that level. C corporations get the new 21% rate, but as part flow-through might be able to take that 20% deduction that I briefly touched on in the last slide. So even though that tax rate looks lower, there's other options that maybe could get you close. See, I goofed these two up here. Distributions are taxed as dividends in a C corporation. Distributions from a flow-through are not taxed because you're paying tax on the whole income and nothing that gets distributed. Because the C Corp is a totally separate entity and it has its own tax situation, there are some losses that could be stuck up in that level. So say you close with losses, where in an S-Corp or partnership that flows through to you, maybe losses are just passed directly to you and you get to use those. Or maybe a C-Corp thing could be trapped. Obviously everyone wants to make money with their business, so hopefully that's not a situation you get in, but something to consider. Certain items are deductible in a C-Corp that maybe would be a tougher deduction personally, so the charitable donations is one thing. Also, if you're in a state with heavy taxes, income taxes, there's with the new Tax Jobs and Cuts Act, the thing that happened in 2018, Tax Cuts and Jobs Act. They limited taxes deductible on a personal return to $10,000. That includes real estate tax, sales tax, and even these taxes that would flow through from an S-Corp and partnership. So if you're in a heavy tax state, maybe you choose to be, for state purposes, maybe you choose to be a C-Corp, so you can get those full deductions. They don't flow through and then you lose them. But obviously there's a million more considerations, but that's just one of them. And then ownership changes on a C-Corp can be kind of difficult. At least just coming from an S-Corp or a partnership, it's a little easier to wing people in and out of those. It's a little more complex to do it for a C-Corp. And if you were to sell the entity as a C-Corp, you would pay sales tax at the C-Corp, and then whatever went to the people who owned it, they would also have to pay tax on that, because it would essentially be kind of like a dividend at that point, whatever got paid to them as the entity winded down. And the flow-through sales are taxed once, so if you sell the assets, maybe, and then you distribute that to the owners, you've only paid tax on the assets, or maybe you sell the whole entity, it's really only taxed once. Oh man, look at all this I got. I just wanted to talk to you a little bit. I mean, a lot of the three that are their own separate entities are very similar, but just kind of how to account for that. So as a sole proprietorship, like I mentioned, no separate anything is required. Just kind of keeping track of what you have is important. If you do file as an LLC for state purposes and you're a sole proprietor, I still recommend keeping the separate something, because it's hard to say, no, this is my separate LLC that made a bad decision and hurt you, or whatever reason you might be sued, which is why you have an LLC for protection. But if nothing's separate, it's really hard to say, well, this is a business asset versus not, and what they can take from you. Obviously, too, we don't want to be in those situations where we're being sued or whatever, but if you definitely have a separate bank account, separate assets, separate everything, it's so much easier to just have that be part of it and not touch your personal. You need to keep records in all cases, but the S-Corp, C-Corp, and partnership do need a separate bank account, do need a separate entity. They do need their own separate accounting, whether that be Excel or whatever it is, but it just needs to be kept separate from your personal. All of them can have employees, but really an S-Corp and a C-Corp probably should have employees, because you're going to be paying the owners. Estimated taxes should be paid in all cases as well. The corporation obviously would pay their own estimated taxes, but as a sole proprietorship or partnership or S-Corp, whatever money is earned in the business will flow directly through, so you need to be ready to pay those taxes. Estimated taxes are always based on the last year. So like your first year into the business, maybe you don't have a big tax payment due throughout the year. Estimated tax payments are just due quarterly. But you know, the next year if you make a bunch of money and you owe taxes in April, that number can be huge if you weren't ready for it. But also then the next year is based on what you earned, and so you're paying that amount each quarter. And so anyways, it's just a change to get used to if you're used to a W-2 where the employee just takes their percentage from you and puts it on your W-2, and you get that, you know, if that flows to your tax return, it's a different situation where you're now responsible for quarterly payments. And in those flow-through situations, it's on the individual. So it doesn't matter what's earned in the business. Obviously it matters, the $100,000 flows through to you, but depending on what my personal situation looks like with my spouse's income or how many kids I have to pay that based on that. And then state taxes apply if you're in a state with tax, which we're not in Washington, but those generally be taxed to the individual in the flow-through cases, and then the C-Corp, it's at the entity level. Although in some cases, S-Corps, and I should probably look up the states, but I think there are a couple states that don't honor S-Corps, so they're basically corps for state tax purposes. So another estimated tax payment to watch out for. And that's it.
I have a question on that
Perfect.
last slide. So on the sole proprietor LLC, it says no separate bank accounts are needed. So you run a business, but all of a sudden you buy somebody lunch, or you pick up a couple of things on your personal debit card. And so what you're saying is you're still protected under the LLC as far as from bankruptcy or something. Now that I've blended personal versus LLC, all of a sudden now somebody did want to sue me because I did buy a few things. Now
Right.
they can't go after all my own personal assets because I did blend.
Right.
Couple
So,
of these
so
other
you're saying
things.
basically you have a separate bank account, but you just pulled out the
Yeah,
wrong card at
'cause I do.
Costco or
Yeah,
whatever, just use a different one. That's fine. Two, what you can do is you can reimburse yourself. So you can
Oh,
just pay yourself, and then that makes sure that the expense is recorded in your entity
But if
correctly.
you do a few, I mean,
Yep,
you're
no.
still protected under
When
the
it's,
Right.
when it's so blurred that
Right,
a
you
lawyer
can't
can
tell.
say and prove that there is no difference between your accounts and that business account,
Bad.
then you allow yourself into litigation.
Okay, got it.
Yep. Yep. So occasional is fine. And for sure you can, like I said, pay yourself back. So
Right.
we'll have mileage or something, maybe you do it once a month. Here's my
Yeah.
cell phone, my mileage, and my
But if- yeah,
accidentals or
that's where, like,
something.
If you're
Yeah.
using your vehicle for,
Yeah.
company uses, but then you get in a wreck and you're on your personal time, that's where it gets, that's where it can get sticky, right?
Yeah.
And that's where, because you're using your company vehicle for personal uses, well, it's not really an LLC at that point, and then that point you get into big trouble, right? 'Cause
But it's
then-
even like your cell phone, like, my business cell phone is on
Right.
our personal plan. But at the end of the year, when I do taxes, I take that portion, or, things like that, the utilities, or whatever.
Right.
Internet, Wi-Fi.
I mean, yeah, you're making your best effort to keep it separate, and there's things that happen. So
Yeah.
as long
It's
as
just-
you
it's
can
just
tell.
your risk
Right.
tolerance, right? So
Yeah.
it's different if you have a vehicle that is a high risk, because you go pile somebody up, or in your vehicle, whether you're on company or personal time, that's where you start to blur those lines. So, and you don't want your personal assets or maybe your company's assets at risk because of something you did on or off, right?
Yeah.
So,
Right.
because
Right.
the company could be
Interesting.
held liable as they come after even as an LLC, right?
Yeah, interesting. Yeah, I've never seen that before.
I do have a question. So I'm kind of leaning towards a partnership C-Corp thing. I got a lot going on. It's kind of really complicated, which I know you're like, oh, partnership, but how I want to structure the people I'm bringing on to work with is like a partnership, but also want to set it up where everybody gets paid like a C-Corp. So how does
Well, there's flexibility in the C-Corp equity, if that's
Right.
the concern.
Well,
And
yeah.
basically, if you want them to be owners, you can look at that from that angle.
That's essentially kind of what a partnership. So each person is bringing in a different skill set, right? Not everybody's going to be doing the same thing, but they're all valued different. So that's why partnerships seem to make sense.
Mm-hmm.
But then it doesn't at the same time, because it just gets complicated then, right?
Right. Well, and I guess everyone just have to understand, as owners, they won't take wages. They would just get distributions, and then they would pay that
Right.
percentage. So if the partnership wanted to be extra friendly, they could make sure that they paid them enough to,
Right.
like, we want you to take home $50,000, so we're going to pay you plus $10,000 for
Right.
the taxes, plus maybe even a little more for the self-employment tax portion. So maybe you pay them $70,000 instead of 50, or whatever that
So
number
here's-
worked out to
okay,
be.
I'll just throw out how it's like complicated, like how I think I could set this up, but don't know if it makes any sense. So each person comes in, and if they're an employee at one point and they come with a great idea that's going to change the world, and they present it to the create tank, because that's kind of what I'm calling it, is so they bring it to the partners, and they say this is the next thing, and everybody believes in it, then that person becomes part of that partnership. But then setting up, because then that would then launch their thing, but the company or partnership would retain a chunk of it, and then a pool would go into paying all the employees. So it's like,
Right.
So I don't know how you.
I almost wonder if some of those things are a new entity.
Yeah, they would be. Each one would
And
be
then, yeah.
underneath the right.
So then you would have different situations
that's where
with respect to that
that's-
new
that's-
entity and what money it pays back and what gets paid to it, and
It's complicated.
yeah, it is complicated.
Right, but that's I think it'd be a good system because, I'm trying to figure out. I got people working with me, right, and they're donating their time and energy and talents. But I'm like, I can't pay you right now.
Right.
But they see the potential in what I'm building, and they really want to be part of it. But how do I structure this so, I'm not trying. Everybody wants to get rich, but I'm not to the point where I want to actually build something that helps build people, right?
Right.
So that's kind of, this is like the third one of these I've gone to and kind of not really sure exactly what I need to set up under.
Yeah. Well, I don't know. Just the easy answer for me is just find a CPA that can definitely walk through, because there's so many factors. I would hate to say something and you go ahead and do it, and then you're like,
Well, no, that's
upset or whatever, but just having someone definitely walk through each way and change with you and grow with you. So as you have an offshoot, maybe that offshoot makes sense as a C-Corp one day, but a partnership the next day because of different,
Right, 'cause
each
the way-
different offshoot and how
what
it
I'm
flows.
thinking of really doesn't exist as this corporation structure, so that's kind of,
Yeah.
yeah, okay. Thanks.
Yep. For nothing.
Hey,
Anytime.
you know what? More questions is always good, though.
Any from you?
Yeah, tax deductions and expenses. I know it's a pretty broad term, but I'm a sole proprietorship, and I do have a separate bank account and expenses for the business, and then I have my own personal one. So I've been keeping receipts and everything that is for the business, and then everything that's personal. I mean, I guess at the end, I gotta figure out what can be written off, what can be an expense, what can be a deduction. I've never really been totally clear on. I know I've got mileage and gas for the times that I'm going on appointments and meetings.
So it'd be one or the other.
Oh,
Mileage or gas.
Oh, okay.
Because the mileage rate's like 57 or 4
Yeah.
or whatever it is
And I have
this
a
year.
little-
But it assumes to include, it assumes it includes gas, oil, maintenance. I mean,
Yes.
it's kind of, because hopefully you're getting better than 54 cents a mile
Right.
gas mileage. So it includes everything. So if you want it, if it's a 100% business vehicle, you would deduct all your gas, all your maintenance, all of that. If it's not 100%, usually the way I say to do it is just keep your mileage.
Yes. I agree.
And then at the end of the day, you just say, I got 10,000 miles at $5,400 or 54 cents, that's $5,400, that's my deduction. Instead of having to keep track too of all of that. And plus, if you do take it personally, you're supposed to reduce. So say you're still supposed to keep track of mileage and maybe it's 80% business and 20% personal. At the end of the year, you're supposed to take your total number of gas, all those things, maintenance, etc., and subtract 20%. And sometimes all that work anyway, you're doing it, you might as well just do mileage because it seems to work out better unless you have some catastrophic engine blown and you're going to include that. But really it just seems like mileage is the way to go, especially when QuickBooks or whoever, Mileage IQ, just tracks it for you.
Yes.
But sorry, I didn't mean to interrupt. Back to your question.
That just makes it easier the better. But then, like you were saying, lunches, shirts for the company just purchased, business cards, everything. I want to make sure I'm not missing anything in there.
Yeah, so I guess we could look at this a little closer, but it details out the basic expenses. You could just Google Schedule C, but advertising, so the shirts, the business cards, the website, car and truck expenses, and it has a little C instructions because it kind of talks you through whether you do the car or you do the mileage or how you do that. Commissions and fees, contract labor, depletion, depreciation, employee benefit plans, insurance, interest, mortgage, other, whatever, legal.
And that's to my own health insurance, not only paying for myself, where I do business, right, renting office space, everything.
Yeah,
Anything and everything.
Anything
that's
and
right.
related to the business.
Anything that you need to run your
Anything and
business would be a part of that. Even like your cell phone.
Yes.
And you don't have to do a portion of your cell phone, at least the way that I do it, because you can't buy a portion of a cell phone.
Sure.
Sort of. So just whatever obviously if you've got family and kids or something on it, maybe you only deduct the main line and the portion related to that. So maybe it's the $90 versus the $10 a line after you do the $90 deduction. But yeah, it's like if it's something you need to use, like internet at home, if you have a home office as well as an office, I'll do the whole internet because you can't, it's like $50 a month. It's not like, you know, some of those. But then if you do have a home office, you just would do a portion of your home, portion of your utilities, a portion of your mortgage, a portion of your real estate, which is down below actually. That's like down at the bottom there. But you can also do a safe harbor percentage too if you just have a small portion of your home that you use and it's not worth tracking all your everything related to your home. It's like $250 to $500 I think depending on square footage, but sometimes that's easier to just say check the box.
Take that minimum.
Yeah, I'm a safe harbor home office person and I just take the small deduction. Especially if you have a separate business entity that you're renting, it's a little bit harder to come up with all of the information to say this portion of my home is only used for my business and nothing else happens here. Sometimes it gets a little blurry, especially if you actually have a business location. So that's something to consider. But yeah, office expenses, which would be like computer, printer, that kind of thing. But then also too, down from that's rent. So rent of your building or your vehicles or your equipment, machinery, repairs and maintenance, supplies, taxes, travel, meals, utilities, wages, and other again. So I mean that's kind of a good guideline, but really anything that is required to do your business is something I would consider. And meals are only at 50%, but that you have to eat and then you're feeding a client usually, so that's why it's at 50%. But yeah, anything you need.
Great, thank you.
Yep.
I have two more questions.
Yeah.
Okay, so one of them, real quick, is I live out in the country and I have a barn, but if I'm starting to run out of space for inventory, if I needed to turn my barn into like a warehouse, and maybe it falls under like SCorps or CCorps, but can I rent the space to myself? Or does that, because everything's flowing under a proprietorship into your single income?
You definitely can.
You can. Okay.
So that would be rental deduction here
Okay.
and reduce your self-employment income.
Okay.
The kicker is you're paying yourself rent. So on
Yeah,
a
so
Schedule
then
E,
yeah,
you
now
have
you're paying.
you have income
Yeah,
of whatever you're
okay.
getting. But then you
Right.
also maybe free up deductions that are personal.
Yeah. Okay.
So maybe you have a portion of utilities that you wouldn't normally get to deduct, and a portion of your real estate taxes, although you probably could deduct those, but
Yeah.
and your portion of your mortgage, and maybe you repair the barn to get it going. So you have a portion of all
Yeah.
those expenses that you're deducting against that income.
Gotcha.
But the big thing is you're reducing your self-employment exposure.
Okay. Yeah, good to
So
know.
it's not like 100%
Right.
gone because you got to pick it up somehow,
Yeah,
but you get additional
Okay.
against that.
So the main question I had when I came here was, so I have a business, but I'm thinking about starting up another one, but I'd like to not have to set up a whole nother business and just more do it as a, doing business as. How do I set that up to run it under my current business without the separate business over here? Is it just a matter of setting it up as, a new company name and just doing it as business as this one?
Yeah, so there
is
is,
that a little
like with
complicated?
it does a little bit, I guess. The Washington State has a DBA, so you would
Yeah.
you could just file as a DBA underneath your current.
Okay.
And then have that situation. I know that in general, for the IRS purposes, I'm picking a business code up there on the other side. The second one down is my business code. Sorry, I'm pointing, but I don't want to walk over here.
Oh, okay.
That's my business code. So I'm saying I'm a general manufacturer or whatever there. Technically, I think the answer is if you're doing something totally different, you're supposed to have a totally separate business because you're doing something totally different, which is a pain if it's small or it's starting. But you
It's a
can.
real estate holding at that point. That's a lot of companies work for the company that runs the machinery doesn't own the machinery. It's owned by a leasing company, but I mean it's all owned by the same person, but they're just different entities so that the whole pie isn't ever exposed. So the company goes broke, the entity that owns the equipment can still just take them and it's not broken. So it's just a layers of protection for whatever you're building, right? Your corporation or so essentially you'd be setting a real estate company up, and you'd be, which there's different taxes and stuff like that on getting income from real estate too, right?
But you're just talking. You're not talking real estate necessarily.
Well, you were talking about
the barn
Renting your
part.
own-
Yeah, no,
your
that was
space.
just another question based on, what I need, and that would fall under the current business, but over here, I'm thinking about starting up another business, and I just want to keep things really
Yeah.
simple and do a
Yeah.
DBA and run it under this, and, even if I had another, website or whatever it is, just whatever.
How different are they, or how similar are they?
So, currently I produce design
Looks like
consult
lunch.
products on Amazon, but I'd like to start up like a box company for people that do, FBA. But I never touch I would never have any inventory or anything like that because I source it all out of China and it would be actually manufactured there and shipped directly to the customer.
Right.
So it would be a box company along with my FBA business, but they're both FBA.
Right. Yeah, I think those would probably be close enough, really. I mean, if you looked up NAICS codes, NAICS, you might come up with the same NAICS code,
Okay.
which is that code at the top there,
Okay.
or a very similar NAICS code. I mean, if you were going to do like, I don't know, hair care and
Yeah.
this box company. I mean, those are different
Those are
enough
really
that like
different. Yeah, I mean,
they're just
yeah.
the different deductions, and so basically they like them separate because there's different things that would go into each, and
Right.
the tax things would be different. And so if you put things together, it's easier to take certain deductions or hit certain limits sometimes, and so it's just they expect them to be separate. I mean, if you have an SCorp too that's doing something, and like you're saying, there's another SCorp that does something, maybe those are different
Yeah.
entities, but they all report under one, or there's different ways to do that too as you get more complex, but I think those seem fairly similar.
Yeah, they're kind of in the same world anyway.
Yeah, it's not like you're selling cars and
Yeah.
doing something nice. Yeah. So I think those would be close enough, but it's always something to, I guess, consider. And I think if you pulled up the Schedule C and just sort of read the instructions on the NAICS code, it might tell you a little bit more about kind of their thoughts on what to expect there. But if you never get audited too, no one is going to catch you. But also,
Yeah.
like he's saying, there is a possibility of wanting to keep them separate for liability purposes. I mean, those sound like similar liability to me, unless there's something that happens in China that causes concern or something, but
Yeah.
that would be the reason to definitely keep things more separate, would be for liability purposes, so they can't take everything if something were to happen. But those don't sound super
Right.
scary anyways.
Smoking a bunch of lead in all your products, and they come after you, right?
Yeah, gotcha.
Now because you have 2 boxes in your barn, your barn's up to the garage.
Yeah. Okay. So it could be pretty simple then.
Yeah.
That's what
Yeah.
the answer would be. Okay.
It's not really simple though, is it?
No,
No.
exactly. Nothing is. No.
That's the barrier of entry.
Yeah. Do you guys have any other questions? I got the wrap-up signal.
I appreciate it, yeah.
Thank you.
That's great.
Oh, thanks guys for coming.
Good, thank you.
Thank you very much.